Hey everyone, welcome back to Corporate Decoder. Today we are diving into a company that's trying to stay afloat, and from what I'm seeing it looks like they are frantically bailing water as we speak. We're looking at Helius Medical Technologies and a recent filing that spells out a new round of funding but at a cost that might make your eyes water. It's a story of debt, dilution, and a desperate scramble to keep the lights on. This report is called an ATK. Companies use it to announce important events to their investors. In this case, Helius is telling everyone about a new deal they made to get some much needed cash. Helius Medical is the company we are covering today. This report is dated April 24, 2025, so this is all very recent information. Now, the most important part of this report is that Helius entered into a deal to get more money. Let's get into the details. To get this money, they signed what's called a securities purchase agreement. Basically, this is a contract with some investors where the company sells them some of its financial assets, in this case, notes and shares of stock, to raise cash. Helius is selling notes with a total face value of about $1.5 million. The deal also includes giving the investors over 1.3 million shares of the company's stock. This is important because it means existing shareholders will own a smaller percentage of the company. This is a common effect in events such as this and is called dilution. The deal is expected to be finalized around April 25, 2025. The company expects to get $1.3 million from this deal before paying fees and other expenses. They plan to use this money for general needs to keep the business running, things like paying employees, rent, and other day-to-day costs. To help them find investors, Helius hired Maxim Group as a placement agent. Essentially, Maxim helped Helius sell these securities to investors. Maxim gets paid 7% of the total money raised, plus they get reimbursed for their legal fees up to $15,000. Here's where things get a little painful. The notes are being issued at a discount of 20%. This is called original issue discount. It means that for every $100 of debt, investors only pay $80 up front. These notes don't have any interest unless the company fails to follow the rules, in which case the interest rate jumps to 20% per year. These notes are due either in July of 2025 or whenever the company does another stock offering. This means Helius needs to find more funding or something else significant needs to happen in a very short time frame. Otherwise, these notes are due in July. There are things called events of default that would trigger penalties. These include failing to pay back the money or defaulting on other debts. Bankruptcy would also trigger a default. If someone wins a large lawsuit against the company, and even just breaking any rule in the agreement, if any of these happen, the investors can use all the legal options they have. The notes can be redeemed if there's a change in who controls the company. And they must be redeemed if Helius raises money by selling more stock or taking on more debt. To try and reassure investors, the company's executives and directors have agreed to hold onto their stock for a certain period. This is called a lockup agreement. This prevents them from selling their shares. This lockup lasts until the maturity date of the notes. The company believes they didn't need to register this sale of securities with the SEC because of certain exemptions in the law. This section just refers back to the previous information about the debt. This part mentions again that they sold equity, meaning stock, without registering it and relying on those legal exemptions. This lists all the documents included in this report. Now, let's step back and look at the big picture here. Helius is in a tough spot. They need money fast, and they're getting it by taking on expensive debt and giving away a chunk of the company to new investors. The 20% discount on the notes is a red flag. It shows that investors are worried about the company's ability to pay back the debt. The short maturity date means Helius is under pressure to find more funding quickly or face defaulting on these notes. The lockup agreements are a way to try and calm investors' nerves, but they don't change the underlying problems. Helius is clearly struggling. The company needs to turn things around quickly to avoid even more difficult financial decisions in the future. This could mean finding a way to boost sales, cut costs dramatically, or even look for a merger with another company. Otherwise, they might find themselves in even deeper trouble. Thanks for watching. If you found this breakdown helpful, please like, subscribe, and leave a comment below. What do you think Helius needs to do to get back on track? Let's discuss.